Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Last week was a pretty extraordinary time for financial markets. Shock inflation figures out of the US saw Wall Street tumble and the ASX followed suit. It's not easy being an investor in this kind of environment. Luckily, our guest today can talk us through what it all means and hopefully what lies ahead. Remember, this is general information only and you should seek professional advice before making investment decisions. Rich Nuzum is the president of wealth at global investment giant Mercer. Previously, he's joined us from New York, but he's in Australia at the moment, so we took the opportunity to speak to him again. Rich, you're becoming a regular.
Yeah, thanks for having me on, Sean. This is my third week-long or longer trip to Australia year to date. It's a really important market for us. And we just had a client conference with more than 300 participants for a day and a half. So spent time talking about the economy, market opportunities, all things superannuation, all things environmental, social, and corporate governance related. So a really good week.
Just before we get on to what's happening on Wall Street and financial markets, as an outsider coming into Australia, what's the mood like amongst investors?
Pretty sanguine given everything that's going on in the world. And I think part of that is a general sense that the superannuation sector, with some minor wrinkles we could talk about, is delivering against its mission of providing both strong retirement income replacement ratio outcomes to Australians, but also visibility on that ahead of time. People know their account balance, they know how they're tracking. And then we are still playing with house money. And what I mean by that is the 10 calendar years ended December were the best 10 years ever for a 60-40 stock bond portfolio in recorded history, certainly for most major developed market currencies, US dollar and so forth. So Australian investors have done really well up until this year. And this year has been tough in terms of stock returns, tough in terms of bond returns, tough in terms of the stock bond diversification benefit that had been there in the last couple of crises, not playing off this time. And there's obviously a lot of uncertainty, but I think the mood's strong because underlying economic growth is actually reasonably strong. Resources markets are up and Australia is participating in that. Employment is at full employment or beyond. That's part of our problem that we're trying to rein in. But on the investment side, we're playing with house money. We're down, but not on a 3-year basis, not on a 5-year basis. We're still ahead of our long-term expectations over, say, a 10-year period.
Okay, so let's get on to what happened last week. The inflation figures out of the US, the sell-off on Wall Street, that filtered through to the rest of the globe, including Australia. There wasn't quite the bounce back that you sometimes see. What do you make of it all?
Well, I'm going to make a technical distinction that's probably not terribly helpful to clients. We had a surprise in terms of inflation and particularly core inflation coming in higher than expected. And the central problem facing the global economy right now is whether monetary authorities will be able to rein in this wage price spiral without putting us into recession. And even though the miss against expectations for the month wasn't large, what it signaled is we're not winning that battle. It's not going the way that we expected. The Fed, the ECB, other central banks are going to have to be even more hawkish than we all thought they would be. And so the probability that we're going to end up seeing the economy have to go into recession, see unemployment spike up to sap this wage price spiral went up. So we had a directional move in the market. And the technical distinction I'll make is we had the worst trading day for stocks since June of 2020. We had a really bad day, a really sharp move. But the forward-looking volatility is not super elevated. The VIX, which is a publicly traded index that measures 1 month forward expected volatility, people are betting serious amounts of money on whether they get that volatility measure right. It's still trading below 30. So it's elevated, but it's not even above its long-term historical norm. So a one-time directional move as opposed to a sudden move on uncertainty. We got a reading that changes our view of the future. It doesn't make the future a lot more uncertain than it was.
Yeah, okay. It's like, what is it? One swallow doesn't make a summer or something or other. I mean, I'm going to use another economics euphemism. The trend is your friend. So just a 1 month's number doesn't necessarily alter. It may matter in the moment, but in the long term, it may not.
Well, I think in this case, it's almost the opposite, Sean. And I'm glad you switched metaphors because I didn't recognize the swallow one. But in this case, we now know the trend is worse than we thought before the report came out. But the volatility around the trend, the uncertainty around the trend is not higher. So, we're in a different future, a less benign future than we thought. but not with greater underlying uncertainty.
Stay with me, Rich. We'll be back in a minute. I'm speaking to Rich Nuzum, President of Wealth at Mercer. Okay, so how do central banks play it? Because there must be a real risk of, certainly in Europe, there's a real risk of recession. The US, there's probably a greater risk of recession now. You mentioned earlier on that Australia was a commodities market, and in some ways that helps us a lot, but still there's a risk of recession here. Central banks are going to keep lifting interest rates. They've made that very clear. Very fine line to walk, I'd imagine.
It is, and I'm glad you went to the regional differences because there's at least three major regional stories that are different. In the US, we have a wage price spiral, we have the dollar strengthening, we have 5.2 million job openings more than individuals available to fill them, so a huge mismatch in the labor market. The US is a resource exporter. The US is not directly and closely impacted by disruption to Russian energy supplies in the way that Europe is. So in the US, the issue is around the wage price spiral and overheating. When you go to the European picture, the disruption in energy supplies is a really big deal. And so Europe is much more likely to go into recession than the US because of the impact of energy price and food price and just having the war up close on confidence and sentiment and real incomes. It's much more likely to go into recession irrespective of what the monetary authorities do. So somewhat counterintuitively, the monetary authorities in Europe have an easier job in terms of reining in the wage price spiral. Getting inflation under control is actually, at least core inflation, less of an issue in Europe than in the US because the labor market's not overheating as much and because the economic sentiment is not as strong given the close impact of the Russia-Ukraine conflict. The third regional picture that we should cover is China. I think last time we talked a few months ago, China's zero COVID policy and its impact on global supply chains was a second massive stagflationary shock on top of the Russian invasion of Ukraine that the global economy was dealing with. That's morphed a bit now. China has done a better job of getting COVID under control. The supply chains globally have unraveled. But because of changes in local housing market policy and just general management of the Chinese economy by the Chinese government, China is looking at a 3% GDP growth for 2022. That's very low by Chinese standards and not what the world has gotten used to seeing from its second largest economy. So that locomotive for our global economy, the Chinese economy, really isn't functioning. And that's a problem. So last time we talked, the issue around China was supply chains. Now it's around China's actually moving to lower growth, maybe not technically a recession, but it certainly feels like a recession compared to historic levels of Chinese growth. So that big locomotive, the Chinese economy, now that we've had Brexit, the Chinese economy is bigger than the EU economy. So it's a big deal to have China not growing. So different differences by region, certainly.
Okay, so let's bring this back to investors. You talked early on about the 60-40 equity bond having 10 years of great returns. If I'm an investor, how should I be thinking about all this? I've got $100 to spend. Where am I putting it?
So we see investors doing three things. One is revisiting their objective. Now that that very strong run is over, what do I think I'm going to get going forward from different asset classes? And, is it enough? And do I need to amend my plans for spending or what I'm contributing? So revisiting investment objective as part of financial plan. And then as they look at the markets, the general trend is I have to diversify better. If I'm an institutional investor, I'm moving as much money as I can, as quickly as I can into private debt, private equity, real estate, infrastructure, all globally diversified. I'm revisiting whether to have a hedge fund or liquid alternative allocation and probably revisiting that favorably and moving back into that space. I may have given up on hedge funds in the last 10 years because anything with a market beta below 1 wasn't keeping up with the stock market. It was insurance that didn't pay off. Well, they've paid off really well year to date. And all of those private market asset classes, private equity and debt, real estate and infrastructure paid off really well year to date. So investors have been reminded diversification smooths the ride. And if I need to make my portfolio work harder because I'm not happy with where I'm going to get to as I look forward, if I just stick with stocks and bonds, then I can move money into these other asset classes, target a higher return, but actually reduce my overall market volatility through diversification. So diversification remains the main free lunch, and investors moving into that. I think the third thing, and this is really different from the last two crises, in the COVID drawdown in March 2020 or during the GFC, those were liquidity crises. And the stock bond diversification actually worked. Stocks got crushed, but bonds actually performed well in the short term. But liquidity dried up. And so there were screaming buying opportunities for anyone who had liquidity. High yield debt, distressed debt, private market asset classes being sold on the secondary market at 60 cents on the dollar. We're seeing none of that this time. So it's a very different market environment than the last two crises. And we have clients coming to us and saying, hey, Rich, hey, Mercer, is now the time to buy? Because the last two crises taught everybody when you get a market crisis, it's a buying opportunity.
Yeah.
We do think it's a buying opportunity in places like emerging market equities or private market asset classes and so on. But we don't have a liquidity crisis this time. There's plenty of cash out there in the system, even with quantitative tightening and raising interest rates. There's a lot of cash on the sidelines and not a liquidity crisis. And so we're advising clients, this is not a time to try to time the market. Figure out what you want to do and get there over time. You can dollar cost average in. We're not telling clients this is going to bounce back quickly given the underlying economic uncertainty.
The other point in this, Rich, just listening to you, for years it seems like passive investing hasn't been a bad option, but in times of change, active investing is perhaps the way to think about things.
I do think that if you're in a position where you can pick your active managers based on qualitative, deep, forward-looking due diligence, do they have the competitive advantages in idea generation, portfolio construction, implementation to beat their very smart, well-resourced peers on the active side? We do believe in active management. And this environment is better for that than kind of a raging bull market lifting all boats where risk doesn't seem to matter. Having said that, passive is still a really good option. If you don't have that level of sophistication, that level of resourcing for your manager selection, you can free ride on market efficiency and you can do it practically for free. But you can only do that in the public markets. So all those opportunities I talked about a few minutes ago, private debt, private equity, real estate, infrastructure, hedge funds, and liquid alternatives, you can't do those passively. And from time to time, we see somebody come to market with a product and say, oh, this is the passive equivalent for those alternative asset classes. It doesn't work. In those asset classes, you're giving liquidity to people who literally have inside information. They have material non-public information. These are not publicly traded securities. When you negotiate with a real estate counterparty around buying a building, you're relying on them. You may contract with them not to misrepresent things to you and so on and so forth. But it's a private market transaction. You're not protected by all the regulation that helps us in the public securities market. So you can only do passive investing for publicly traded stocks and bonds. There are less than half the publicly traded stocks available in developed markets that were available 20 years ago. The private markets are just becoming more and more important. Venture capital, private equity, infrastructure, more important as part of the overall economy. And so not being able to participate there puts you at a disadvantage. One way to look at it is if you think about where there are two kids in a garage that are innovating and looking to take down an entire industry sector, they're in the private markets. They're in the venture capital space or early stage growth. They're privately owned. And that established industry sector doing something in a traditional way is in the public markets. So when you invest passively, you're loading up on past success, you're loading up on established business models, and you're structurally underweight innovation compared to an investor that can do private markets. My last comment on this, I always love coming to Australia because this is the geography where the government and regulators in the industry has done the best of making private markets available to retail and defined contribution investors. When I travel around the world, an Australian superannuation investor can get 35% in alternatives, professionally managed by a combination of in-house staff and third parties. You can just walk in off the street and pick a super fund and get that. And that's not true in the US. That's not true in most markets around the world. Access to private markets is a real problem for the mom and pop and man in the street. It's not in Australia. And I think that's a wonderful credit to the local industry.
Rich, thanks for talking to Fear and Greed.
Thanks, Sean, so much for having me. Just to kind of sum up, we think if you're a long-term investor, now's a great time to be putting money to work. We are living through uncertain times, interesting times, and some big uncertainties out there. But long-term, things are very bright. Ultimately, the problems we're having are driven by full employment, overemployment, too much economic growth, too much stimulus, it's relatively good problems to have against the grand scheme of history.
That was Rich Nuzum, President of Wealth at Mercer. This is the Fear and Greed Daily Interview. Remember, the information is general in nature and you should seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.